In exchange for providing downside protection on indexed accounts, an insurance carrier limits some of the upside potential should the market grow. Generally, insurance companies limit growth through three levers: cap rates, participation rates, or spreads. A strategy fee may also apply. Let's take a look at each of these terms. A cap rate or index cap is the maximum possible interest rate that can be applied to your indexed account. For example, if the index grows 10% during a crediting period and the cap rate is 6%, your indexed account will be credited 6%. A participation rate is a percentage applied to index performance. In other words, the percent of the index growth experienced will be applied to your indexed account. If the index grows 10% and the participation rate is 50%, your indexed account will be credited 5%. 10% index growth multiplied by 50% participation rate equals 5% interest credited. A spread rate is the percentage that will be subtracted from the growth of an index. If the index grows 10% and the spread rate is 3%, your indexed account will be credited 7%. 10% index growth less 3% spread equals 7% interest credited. Some indexed accounts may have a strategy fee. A strategy fee is the percentage paid on certain indexed accounts. Accounts with strategy fees may offer higher cap or participation rates than accounts without a strategy fee, which means that it is possible to have a higher return than an indexed account without a strategy fee. It is important to know that your contract value may decrease if the indexed account earns less interest than the amount of strategy fee assessed. Generally, the fee is assessed when the segment matures. Cap rates, participation rates, spreads, and strategy fees are set at the beginning of each segment and may change for future segments. This means that the rates and fees applicable to the accounts you choose when purchasing your contract may change after the segments you selected mature. So you now understand how you will see your account grow. How do you take money out of your account when you need it? We'll answer that question in the next section.